So welcome back, everyone. Thank you all for being with us right through the day. I do hope the presentations give you a very good ringside view of ITC and what lies ahead. We have received over 100 questions. Our team has been busy bucketing these questions received throughout the day. At the outset, let me thank the gathering here for such involved participation. Let me first take a few business-related questions before we take overall questions related to ITC. The first question is, the first set of questions is on the cigarettes business. An expert panel has been constituted by the Health Ministry to recommend a taxation structure for tobacco products. What's the company's perspective on this, and how should investors think about growth prospects? Has there been a dialogue with the government on reasonable taxation policy? This question has come from several analysts, including Edelweiss, JM Financial, Jefferies, Investec, Centrum Broking, Spark Capital, and YSIL.
Okay, thank you, Karthik. So, this dimension of the Health Ministry making recommendations on taxation is a regular event. It is not that this is the first time it has ever happened. We understand that this is an aspect that is on which recommendations are made on a regular basis, I would say an annual basis. Second, this time the focus is not merely on cigarettes, which has received the brunt of taxation. It is for all tobacco products. It is a much wider area that it's being looked at. The figures of 75%, etc., that are being quoted in some media as a recommendation of WHO. This is a continuing kind of position. It's not something unique or just suddenly happened. And in the process of looking at taxation, Finance Ministry does receive recommendations from various stakeholders on many facets, and including this particular category, including the fact that the Tobacco Institute of India also makes its presentation. So all the inputs are given, and it's then the ministry takes a final view on what is to be done. And as we have shared some data in our presentations, that during periods where taxation went up at a steep rate of 15%, revenue collections grew only under 5%. And in periods where there was stability, the legal industry was able to claw back, and revenues grew at 10%. We've also spoken about the extent of seizures that are happening of illicit products. In fact, there is hardly any day where media does not cover it. I think there has been also a parliament question where the data was shared on the extent of seizures. That shows how cognizant the enforcement and policy makers are of this menace that is coming, and the impact it has not only on the revenues but also on farmers, which are a large stakeholder in the economy. So one would hope and expect that all these data points will be considered when an appropriate decision be taken, looking at all the facets. And given these data points and information available, I think we should expect these to be taken on board for a reasonable view on that perspective. And if you may also, just to mention, take a note that whilst taxation is been a serious concern, it's been a bigger concern in the period between 2011 to about 2015-16, and then also during the GST transition, which, as per the reports that are available, was intended to be a revenue neutral transition. First, it turned out to be a transition where there was a lower rate of taxation, and then in the second change. When the attempt was to make it revenue neutral, it actually became higher. So that was not an intended, as per the statements that are available. And then after that, we've had in February 20. So it's been a little more, I would say, the recent experience has been that it's a little more paced out. And I hope that this is on account of the awareness of the challenge and issues that surround this industry. There have been other factors that have impacted this industry during this period, which is more to do with the, disruptions on account of the pandemic. So given the circumstances and the data available, the information available, I hope all that is taken into account and a more reasonable perspective emerges out of all the deliberations and decision making.
I'll go on to the next question. There are two questions. I'll probably cover one after another. One relates to illicit cigarettes, which you briefly touched upon. The second question first is, do you see GST compensation cess being extended beyond 2022? What would be the likely taxation structure for cigarettes after the cess is discontinued?
Okay. So, as far as the compensation cess is concerned, it is meant to be till the middle of 2022. Anything beyond that does require a constitutional amendment. What we understand is that, I'm sorry, let me correct myself. It is supposed to be there till 2022 to compensate states, and any requirement to compensate states beyond 22 requires a constitutional amendment. However, there can be a modification to the act to extend the levy of the compensation tax to pay for the or to take care of the interest and loans that have been taken on account of the revenue shortfalls that have happened during the pandemic period. So to deal with that, I believe the levy will stay for some more years, and there is no information available to suggest that there'll be any further attempt to compensate losses or compensate states beyond 2022. In fact, the issue of lower revenues is being addressed by looking at the overall rate structures and the rates across categories, where there is a group that is working and looking at that area.
Thank you, sir. The next question relates to illegal cigarettes, on illicit cigarettes. These have grown sharply in the last decade, which was also covered in the presentations that the businesses made earlier. How are the trends now? Also, can you please give any specific color on the company's engagement with policymakers on this issue?
See, during the recent past, which is really the period from March 20 to now, I think the period has been marked with disruptions to the economy and disruptions particularly to items like cigarettes, and they are well on, as my colleague Sandeep shared, the recovery has been quite robust this year as compared to the prior year. So that's been, I would say, the dominant issue in the last couple of years. Prior to that, I did share data that in periods, and that was a period when we experienced some stability, that revenues actually grew by about 10%. And that is largely volume led, because there was not much because of taxes did not go up, it did not change prices materially. So largely volume led growth during that period. So that's the correlation. This is a very recent data. And the reason I also explained earlier was that, cigarettes is just 8% of the tobacco consumption. And there is some interplay between illicit and legal cigarettes and also other forms of consumption. So in periods of stability, we do find that legal cigarette industry is able to claw back, particularly from illicit, and that's what we experienced in the past. So with stability, we do expect the volumes to firm up, and with the The economy also stabilizing, the high frequency indicators doing well above, some of the indices are well above the pre-COVID levels. I think this augurs well for the economy as a whole and for this category also in particular.
The next question relates to structural decline. Basically, the question says, we gather that cigarette volumes are back to pre-COVID levels now, but do you think there could have been structural decline during the pandemic, whether due to work from home or from other reasons? If so, to what extent? And how do you see growth in volumes going forward? Has there been any mix impact? How should the investors think about conversion from other tobacco forms to cigarettes?
Okay. First of all, we have no data to suggest that there is any structural change. Rather, I would say the robust recovery that we are seeing does seems to suggest that it is kind of normalizing. It is really normal to what it was prior to COVID. Yes, during the disruption, there is some impact because there is some correlation between mobility, correlation between going out to and because this is also a category that is perhaps the most often transacted category, because it's not something that you stock up for a week or a month or something. It's a daily stock up, sometimes even more than once during the day. So mobility, etc., tends to kind of create some disruptions or create some lower velocity of sales during some period of time. But structurally, there is no evidence with us to suggest that. In fact, we are only seeing that it's getting back to where we were. It's getting back to where we were. And as far as interplay with other categories is concerned, volumes going forward, I think I've largely covered the whole philosophy in my earlier answer.
Okay. Thank you, sir. The next question relates to we did not see any price increases after the last increase in March 20 after the taxation change. How should investors think about pricing as a lever? Will pricing lever be used only when taxes increase? What is the view of the management on this?
Okay. So I think just going back to your earlier question, I think there was an element on the mix which I may not have addressed, but as part of this question, I will address it. As we explained during the day, I think the imperatives for us is one, to maximize the potential of the cigarette category within the basket of tobacco consumption. And number two is to fortify market standing and also to counter illegal. These are the kind of objectives and priorities we work with. And to enhance value capture and to deal with these objectives, there are levers of innovation, brand portfolio, accessibility, execution at the last mile. These are the levers that we use. And more specifically, as far as value capture is concerned, the levers are pricing, mix, volumes. These are essentially the levers. And we deploy a combination of these levers. Now, when there is tax stability, we do find that the industry is able to claw back from illicit industry, able to claw back from other forms of tobacco consumption. So I believe during that periods of time, of course, this is not a cookie cutter answer. It has to be contextual at that point of time. But at the broader principle, mix and volume are better weapons at that point of time. When there is tax increase, you need to pass the tax increase you have to pass it on into the price. So that's where the pricing lever becomes more important. And then you work on pricing, you work on mix, volume becomes a weaker lever at that point of time. So you have to play with these levers. And I might also add that during this period, what we are finding is that there was a question on mix. I think the mix is getting richer. It is getting richer. Of course, stability is helping. In addition to that, I think the sharper execution of innovation, and there have been some very interesting innovations in the recent past that are helping this. So the premiumization is certainly, mix is getting richer. backed by innovation and backed by better accessibility to this innovation. So the last mile execution of the assortment also has significantly moved up. That is helping us to improve the mix.
Thank you, sir. The next question is on electronic nicotine delivery systems. Is the ban on e-cigarettes, e-vaping, and heat-not-burn products, etc., likely to be lifted? How does the company view this segment, and how would it respond if and when the ban is lifted?
It's difficult to do kind of crystal ball gazing on what is going to happen. However, let me make the following points. Number one, recently as part of the COP meeting or an outcome of the COP meeting, I think the position that WHO has taken is that the evidence is not adequate on its harm reduction, and there are certain risks associated with the other categories as well. Number two, India is not the only country to have banned it. There are many countries that have banned it. Number three, in India, when the ban was done, one of the concerns was that these could act as a gateway product, and such similar data had come out from other parts of the world as well. Having said that, and we do recognize that it is impossible for us to predict what would happen in the future. It's always possible that a change could happen, and it is also possible that the change could be the other way around globally. So we do not know. As an organization, you have to be prepared to be able to play in whatever is legally allowed. We were into this category before the ban came in, and we were also had developed some advanced systems before the ban did come in. And our endeavor is to be in touch continuously, be engaged in this. Be aware of what is happening, and also build our capabilities so that if and when, or if and ever this is ever opened up, we should also be equipped to play in this category.
Sir, with your permission, I'll now move to the FMCG segment. The first question is on the immense cost pressures in the FMCG industry. What is the company doing to mitigate the impact on margins?
So, Supratim, would you like to take this?
So yes, I think it has been touched upon in the previous presentations that we are seeing unprecedented inflation in commodity prices, whether it's edible oils, whether it's kraft paper, whether it's crude palm oil and soap noodles. I think all of the large commodities have seen huge inflation. But I think the good news is that we have been able to mitigate the impact of cost inflation very effectively so far. It's been a challenge, all right, but I think we've done a pretty healthy job of retaining our margins or sustaining them at about 9% EBITDA for the FMCG segment for the first half. This has been possible because we've kind of looked at every element of the P&L, whether it's promotions, trade promotions, whether it is getting to the market in a more sharper way, and looking at more effective ways to communicate and therefore get the best bang for the buck in the circumstances. Whether it is leveraging some of the structural interventions that we put through in the previous years, whether it's shortening distance to market, whether it's really acting very agile in a very agile manner in the marketplace. These have all helped us to kind of mitigate the challenges. Of course, we've also been active on the pricing side, but we've been judicious there in the scheme of things because we don't want to also destroy demand. And where we have market-leading positions, we've also actually initiated some of the pricing changes. So, like I said, I think it's been a holistic way to look at it. And the good news is that we've been able to kind of maintain margins at 9%. Of course, the challenge is not over. I think the year is still, 6 months down the line. We have to see how we end the year. But this has to be seen more as an aberration. It's not something that is hitting ITC only. It is true for all industry players, and I think you've seen that in all the numbers. So our endeavor is going to be leveraging all possible fronts. to mitigate the challenge. Like I said, all these measures are still being put through. We've taken some more price corrections, and I think we will be able to kind of do the best going forward as well. Chairman's presentation in the morning also talked about extreme cost focus. So some of them are obviously structural. They're there with us, and there are some that we've done tactically to deal with the problem. So I think as a combination of all these factors, we should be able to kind of mitigate the challenges that we have in front of us.
Thank you, sir. Moving on to the next question. There are some categories in your FMCG businesses which is still low on scale even after 3 to 5 years in your portfolio. How do you evaluate your portfolio choices, and when would you take a call on retaining or discarding these categories? A supplementary question: why are we into so many categories? How are we thinking about scaling up newer categories? This question has come from several analysts, including IIFL Securities, Ratnabali, Kandelian Asset Advisors, Investec, and so on.
So, as I said in the morning, the aspiration is to build an FMCG business of scale, and to do it quite rapidly. That is the aspiration with which we started. And to do so, we said we will leverage institutional strengths. Now, in this context, I explained in the morning our portfolio perspective. Number one, we're saying we have certain power brands in our portfolio like Ashirwad, Sunfeast, Bingo, Yippee, Classmates, Savlon, and so on and so forth. So we will scale and fortify these brands. We will invest behind these brands, much sharper innovation in these brands. Second, we are going to use the strength of these brands to address adjacencies. For example, Ashirwad, which is a strong center of plate brand, is straddling certain additional areas which are more value-added adjacencies, be it vermicelli, be it organic pulses and atta, be it gluten-free atta, be it sugar release control atta, be it salt and spices, or for that matter, ready to eat meals, etc. So it is straddling certain adjacencies, and similarly, Savlon has also straddling some more vectors of innovation, as my colleague Samir also explained in the morning. So there are the power brands which are being scaled up. Number two, we are using the power brands to get into adjacencies. These adjacencies are not necessarily pan-India. It could be with regional focus also, depending on where we cite the market opportunity. And the third piece is about building categories of the future. Within the categories of futures, there are stuff like Nimail, like ITC Master Chefs, or Be Natural, which we are building at a pan-India scale. There are other pieces like maybe Sunbeam Coffee. We are testing these. We are piloting this in certain beachheads, or dairy for that matter. We are piloting them, testing them in certain beachheads, establishing the right to win, establishing the business model that will be value accretive when we were to scale up. So once we have fine-tuned this model, we've done the experiment, we are through with designing our business model, and we are ready to roll out. At that point, we'll take a call when to roll out and when to scale it up. Because we have also said that at a point of time, we want to do only a scaling up of certain number of categories. We don't want to scale up everything at the same time. But we will keep on experimenting, we'll keep on learning, we will develop capacity, we will understand category nuances for newer areas, build the expertise, and because we do it in certain focused geographies and not everywhere, there is a focused attention on it, and there are separate teams that will deal with it to ensure that the focus from other categories is not taken away. That's the philosophy we have, because we do want to build a much larger FMCG business so that it becomes a substantive economic engine commensurate to the size and scale of what ITC is today. So that's the reason we are building many categories together, and we have certain institutional capabilities that will help us build it. So that's the way we look at it.
Thank you, sir. Move on to the next question. Several analysts have asked about ITC's FMCG businesses margins. While they are improving, they are still well below other FMCG players in the industry. What could be the reasons, and how should investors think about the trajectory over the next 3 to 5 years? But by when do we think EBITDA will reach higher levels, early teens, mid-teens? Any guidance that the management can give? This question has come from several analysts, including analysts from Credit Suisse, Investec, Carnelian, and JST Investments.
Supratim, would you like to take this?
Partly, the chairman already, explained the reasons why the margins are slightly lower than the FMCG peer set. We've been obviously, building this FMCG, engine for growth for ITC. We are relatively new starters. We have a clutch of brands. Some are mature, some are emerging, and some are nascent. So I think when you look at it together, you see a 9% EBITDA margin. So some of the more mature, brands, and I think Hemant's presentation showcased some of the power brands that we have in foods. They are of a much better, kind of a margin profile in the double digits. And I think, the kind of movement that we've had in the last, 3 or 4 years have been really appreciable. We made solid progress on the bottom line from a margin perspective. And like I mentioned before, we have a set of structural interventions that are coming to life as we are getting more scale. We are able to deploy some of those in the marketplace more effectively. And that's why you're seeing that the margins are actually still, getting sustained despite such inflationary pressures. So we cannot give guidance as to where the margins are going to be headed, but we can only say that we are confident of maintaining the trajectory. Of course, this year has been a bit of a challenge, like, we mentioned in the morning as well. But I think, the structural drivers of margin expansion are very much in place. And as the brands gain scale, we should see the trajectory kind of getting, sustained and getting better. So that's one. So I think, overall, to say, when exactly is going to be 13, 14, 15%, we don't give that kind of a guidance. But you'll have to take heart from the kind of movement that we've delivered in the recent past, and that should give you some kind of an indication. Our aspiration or our commitment, like the chairman mentioned in the morning, was to grow the top line in the top quartile of industry. So really peg it at that kind of a level. And with sustained margin expansion, we should see our, absolute EBITDA also growing substantially in the next 2 to 3 years.
Thank you, sir. Move on to the next question. Certain categories like biscuits and hygiene products were helped last year because of increased at-home consumption and pandemic-related tailwinds. How does the company think about increase in market share and in growth in these categories?
That's a good question. And I would say that it's not just merely about biscuits and hygiene products. Even other categories like noodles, categories like ready to cook, ready to eat, some of them experienced heightened consumption, a surge in demand. So certainly more people got exposed to the categories and more people got exposed to our brands. So this does help in 2 ways. It can lead to a heightened awareness around the benefits of certain categories, and that can sustain. And second, it leads to a larger number of consumers having experienced and tried our products. So, for example, while the spike that we saw in the hygiene products has moderated, but is still settled at a much higher level than what it was pre-COVID. So category as a whole is expanded, and that offers opportunity. And our endeavor, and in many categories we have seen, our endeavor is to grow ahead of the category growth rates, so our market standing improves, and that's the focus with which innovation and new products and distribution is scaled up.
Thank you, sir. Moving on to the next question. How is ITC gearing up against possible disruption to its key institutional strength of distribution with the possibility of digital disruption by certain eB2B players? There is a genuine concern as to what would happen to traditional distributors. What is the company's perspective on this?
We have to be available in all channels from which consumers buy or trade buys. So therefore, we are available and we will be available in all the channels. Now, each channel has its own uniqueness. Each channel has its own nuances. So one has to understand that and create a service pack that is relevant to that particular channel in terms of servicing, in terms of assortments, and so on and so forth. To remain, and all these interventions have to be taken to ensure that we sustain a better position in these channels. As far as general trade is concerned, and this is the backbone of distribution today, it's a very large segment, and it's serviced largely by company distributors. So this channel is here to stay. It is dominant. It will continue to be dominant. And our partners, as our partners, we work with all of them in helping them enhance their capacities, in training their field force, in helping them organize themselves better through better ways of managing inventory. For example, we have a lean inventory model with all large distributors. We're also helping them digitize with various apps and systems that we have developed over a period of time. And we will continue to work with them to help them build capabilities and help them strengthen their value proposition to the retailers. We've also got on the app, we've also got solutions for retailers to be able to get access to credit on the same app that they order. So a variety of actions are being taken to strengthen the value proposition of the general trade. They are the backbone. They're long-standing partners, and we'll continue to work with them in mutual interest, help them build their business while we have clear strategies and a clear position, and we will play in all the other channels also.
Thank you, sir. The next question is from Edelweiss and Analyst from Edelweiss and HSBC Securities. This relates to e-com salience, which has grown in the last 2 years. How is the company positioned in this fast-growing channel, and what are your plans to win in this channel? As D2C is a digital focus, what could it look like in the next 5 years?
Yes, we have grown quite well in e-commerce, and we are going to continue to invest behind e-commerce. At an aggregate level, we are at 70%. In some businesses like personal care, it's already in double digits. We have dedicated teams to deal with e-commerce. We're equipping our e-commerce teams as also a larger community within ITC on cutting-edge skills to win in the e-commerce channels. We have brought in the global best to provide training to our employees. And as I said earlier, each channel has its own nuances and own unique strategies and interventions to win in this channel, around assortments, around the way you market and communicate in the channel, around the manner in which you service these channels. And all these elements are taken onto board, and we have a joint business plan developed along with these channel partners to ensure that we stay ahead of the curve. So we will invest ahead of the curve in this channel for sure. As far as digital first and D2C is concerned, I think I would say we have made some progress, and during the pandemic, actually the progress has got accelerated because digital adoption happened at a very rapid pace during the pandemic. So some of our brands have actually pivoted to become digital first brands. We've also launched a D2C platform, which is the ITC eStore. We made some investment in another company. And outside of FMCG in agribusiness, we are also building a platform which is called the ITC Mars. So this will be an area that will certainly see increased investment, And I think a greater proportion, certainly of our sales, should come with these digitally enabled channels over a period of time. I'm not going to, forecast any number, because this also depends on how this channel evolves and at what rate digital adoption takes place. In this space, I think what is important is to have the capability, have the commitment to invest, and be agile, and take stock frequently and recalibrate investment, because it's a space that is fast evolving. And that's the approach that we will take it. And our endeavor is that we must win in this channel. Our shares in this channel must be ahead of what we are experiencing in other channels.
Thank you, sir. The next question relates to the staples part of the portfolio. Ashirvad portfolio has scaled up very well. Could you please talk about its margin journey? Also, what are you thinking about in terms of the foray into other staples such as pulses, rice, soya, oats, etc., given the success with atta?
Okay. The first part of the question, we will take it later, and maybe Supratim can speak about it, really for maybe some perspective on margins of some of our bigger categories, not mainly foods. We also have Classmates and we have Mangaldeep and things like that. As far as the other areas that Ashirvad will get into, it's a strong center of plate brand. It's a very powerful brand, has a very high spont and tom. But we are going to use Ashirvad to get only into value-added adjacencies. So adjacencies that are value accretive is what we will get into. And this is examples of this have been shared during the day. Vermicelli, Hemant talked about poha. Then there is a range of other ready-to-eat stuff. There is, value-added atta. In fact, there is ready-to-eat chapatis also, which is being piloted in Kerala, because that market is evolving in that direction. So we want to stay ahead of the curve. So it will be value-added adjacencies, which we will get into. And with scale, mix enrichment, and the scale leverage, operational synergies will also give us additional margins. Now, specifically on the journey, on maybe some of our bigger brands in Ashirvad, maybe Supratim, you can come in there.
I'll be mindful of not calling out any specific numbers, because those are, not available in the public domain. So I'll restrict myself to the overall numbers. But just talking about the 4 or 5 big categories, like I mentioned before, they've had a very good trajectory in the last 3 or 4 years, and that's one of the reasons why you've seen that the overall table of margins have actually improved quite substantially over the last 3 or 4 years. Like I said, about 640 basis points from FY17. This has been powered by the 4 brands that we talked about in the morning, and also some of the other categories like Classmate, notebooks, etc. Even the Mangaldeep Agarbatti business. Some of these are in the double-digit EBITDA margin profile, which is continuously kind of helping us increase the profit pool of the FMCG business, and also helping us on the profitability side per se. So I think some of the journeys that are there in the recent past have really got to do with the premiumization of the portfolio, the go-to-market strategies that are involved in all of these categories, and the constant kind of takeout of costs in the supply chain that has helped us in this journey. So if you look at atta per se, I think you have to look at it slightly differently. The name of the game there is to really convert and really seize the opportunity more than chasing a profitability metric as a percentage. What we're trying to do there in the category, like it was mentioned in the morning presentations, is also to look at the realization per kg. So atta obviously is at a relatively lower NSR per kg. The game within the staples category is really to move up and address value-added adjacencies. And the example of vermicelli has been already talked about. The endeavor really is to move up the value ladder and really get the NSRs per kg up using the Ashirvad franchise. So the ATA, how the staples game is slightly different. We're not really just chasing profitability as a number. We're trying to really maximize the opportunity of a profit pool by leveraging the very strong brand that we've created in Ashirwad.
Thank you, sir. I'll move on to the next question. Basically, another couple of questions in FMCG before we get into the other businesses. Obviously, I'm not taking the questions relating to structuring at this stage. That I'll bucket and take it at a later time together. Can you elaborate on working capital management measures, given that some of the presentations covered ICML strategy quite well? Can you please elaborate on working capital management measures in the FMCG business?
Supritam, would you like to take it? Yeah.
So it was on working capital? Yeah, so working capital, I think, if you look at firstly, we don't have debtors. That's a great, kind of a business model that we have. It's largely a cash and carry, kind of model, largely speaking, but for modern trade and, some institutional sales and e-commerce, large part of our business does not have exposure to any debtors. What we do have exposure to from a working capital perspective is inventory. We have a lot of inventory on the books because of the ATA business. We buy a lot of wheat during the year and we consume it through the year. Of course, the dynamics of a particular year may be different, but typically speaking, we do buy more wheat at the beginning of the year or the first half of the year, and we consume it through the year. But overall, from an intensity perspective, inventory is the big one. And if you look at our classmates business, the stationery business, the debtors component is high because it's a credit business, and the wholesale dealer has to be rotating his money, and there is a certain amount of credit that has to be given. But having said that, I think we are looking at a lot of initiatives out here, starting from smart buying to taking the right kind of hedges at the right time, using a lot of technology, a lot of digital to help us guide in that journey. So I think these are the interventions we are looking at. We are also looking at kind of, especially in the stationery business, early collection through incentives so that debtors don't get kind of extended, especially in the uncertain conditions of the market that we saw in the last 18 to 20 months. So we've been quite sharp and agile in the marketplace. A lot of focus on collections in that business. And I must say that even while sales were subdued because of what happened last year, in that business we were able to collect the highest ever kind of numbers in FY21. So I think there's a lot of focus on working capital management. But the big one, like I said before, is the wheat inventory that we have on our books. That is for the ATA business. And the name of the game there is to really sharpen the buy, the timing, and also to ensure that we have the right buying strategy from a timing and a geography perspective. And that's where our agri-business comes into the picture. And what we are doing now increasingly is to use a lot of digital tools. Like I said, we have something called Project Astra, which is now running for the second season. We are hoping to get better and better using that tool as we get more and more data into that algorithm based system, and we will obviously leverage that to the hilt as we go forward. So I think we have a 360-degree intervention from a working capital management perspective, but like I said, the big element of debtors, which many other companies may be having, we don't really have too much of that. The focus is on inventory management and also using a lot of digital and technology to sharpen our buying processes.
Thank you, sir. I'll move on to the next question. The last question in FMCG before we move on to the other businesses. Some investors have asked about benefits under the PLI scheme now that the approval has been granted. What is the investment amount committed, which areas, and what is the sizing of the incentive amount that the company is likely to obtain?
Supritam, will you take that?
So I think, in the morning presentation, Hemant did mention about ITC being chosen or has been, selected as part of the PLI scheme, and we've got, on the three buckets, the ready-to-eat, the fruits and vegetables, and marine. Marine is, of course, very small, but the first two are relatively big. Again, the numbers are not out in the public domain, so I'll refrain from giving out the exact numbers, but it's ITC would be one of the largest, players committing to incremental investments on the PLI scheme, and the scheme is quite well understood. There is a threshold of top line growth that is required, and you get a particular level of incentive which is capped to the particular categories overall investment or the budget that the government has. So we should be able to recoup the total investments in the medium term through the incentive route. But what it really does is to give a real push to investments in food processing and also to brand building, which is really very close to our heart. As you saw in the morning, we have incubated a lot of Indian brands, and this really gives us a window and a support from the government, and it's very welcome from the government to support companies like ITC, who really are the largest incubators of Indian brands in the country. Like you've seen, our exports have doubled in the last 2 or 3 years, and we really want to use this as a good support for us to scale up in target markets in the identified categories. So we have, Hemant talked about certain markets. We are looking at many more, and I think this is a big support that we will get through the brand building expenditure reimbursements that we will get from the government, quite apart from the first 3 buckets that I talked about. So it's quite a encouraging scheme. We are very thankful to the government to do this in quick time, and we will do our best to leverage the scheme to grow the business and scale up Indian brands in export markets.
Thank you, sir. One last question on FMCG. In the new strategic landscape, is the previous target of 1 trillion in terms of revenue by 2030, is it still valid?
Well, when the target of 100,000 crores was spoken about some years back, that was, I think, more to articulate an aspiration and vision of the enterprise, right? And when it was articulated, it was probably a target which was envisaged at maybe 17, 18 years later. So it was more in the realm of an aspiration and to galvanize the enterprise to create a business at scale, and also so that this whole aspect about scale comes into the thought process, right? That's the background to this, and we are still committed to building a much larger FMCG business than we have today. And we've articulated today our approach, and we have very clearly said that the categories that we will enter into, even in staples, although in staples itself, we probably enjoy unmatched advantage and efficiencies because of scale. But we would like to get into more value-added segments, leveraging the power of the brand there, because we are very committed to growing at the top quartile of the industry, and at the same time, we want to sustain the trajectory of margin improvement that we've had in the last few years. Yeah, we know that this year is an aberration for reasons that we have already articulated, but we would like to continue this trajectory and be in the top quartile of the growth. That's how we are seeing the future of FMCG industry. And yes, there is clearly a lot of headroom to grow in all the areas that we are into. And given that per capita consumptions, given that penetration levels are low, I think there is immense opportunity to achieve this kind of aspiration.
Thank you, sir. I'll move on to the hotels business. What is the status of recovery in the hotels business? Second question, finish off the hotels portion. With waves of pandemic in varying degrees across different geographies, do you think there could be structural long-term impact on business travel? If so, how is this likely to affect the industry and ITC's own hotels business?
Well, in line with the much faster recovery that we have experienced post the second wave, even the hotel industry is posting a much smarter recovery. I think the increased vaccination is providing further confidence to people to travel. So we saw in Q2 itself, we were, at least at the cash level, we did not lose any money. We were cash positive. And with the progress that we have seen in the industry, we now find that leisure destinations are doing well. Leisure travel is doing extremely well. But yes, bulk of our business is also business travel. Business travel is maybe about 40% or 50% of what it was pre-COVID. ARRs at about 70% of what it used to be pre-COVID. Occupancy levels are more or less, we've achieved the pre-COVID levels. So all in all, there is progress. And I think, as I said, first quarter, we were cash break even. I think the trend this quarter is even better. So it should be, we should look at a better, all indications are that it will be even better in this quarter. And with the vaccinations progressing, with the case count being low, I think progressively, the industry will continue to pick up. It should be on a much firmer wicket next year, though it may take a little longer to completely normalize. Now, as far as the structural changes are concerned in the industry, I think I want to call out a few things. One, the common trend we saw in FMCG of people preferring trusted brands, I think comes here also. So hotels that can assure safety, hotels that can assure hygiene, or brands that can assure them will certainly be preferred. And in ITC hotels, we have the VAssure program. It is the only program that is certified by DNV. Number two, work from home and meetings through virtual means is a reality of life. It is going to stay. But which way will it work? Is it going to work? Is it going to work in terms of reducing travel? Or is it going to work in a way that I take less frequency of travels, I spend more days in a particular location, do all my work, do some of my work online, and then go back instead of making frequent trips to that locations, because I can work from any location. So these are things that we will see in future. But anecdotally, I have seen people that have traveled to cities for a longer period of time and try to wrap up a range of activities while they continue to do office work from the virtual meetings. So this is something that will evolve over a period of time. The other factor to keep in mind is that the outbound tourism in India is far greater than inbound tourism. And I think with this, during this pandemic, a lot of us have experienced what India has to offer. And I do hope that this will have a rub-off effect, and actually some of the outbound tourism will actually over a period of time get converted to inbound tourism. So I'm quite optimistic that going forward, the industry will continue to progress and will do well.
Thank you, sir. I'll now move on to some questions on the Infotech business. And this question has come from several analysts. The company has been highlighting the performance of this business in its quarterly investor presentations. What is the company's view on this business potential of this segment, of this business? Is the company evaluating any M&A in this business?
Yeah, we see tremendous potential in this segment. It's a very large segment. It's an area where India has strengths. And I think more specifically at a time of disruption, at a time when digital technologies are directly being leveraged to create business outcomes, I think at that point of time, domain becomes important. Interplay between domain and technology becomes important. And the fact that Infotech is into some verticals where ITC also has domain strengths, that gives us some, strength from a domain perspective. So I think the opportunity is immense, and that's why we are providing impetus to this business. That's why we have brought in the right talent to power this business. Yes, in this space also, in this industry also, we are absolutely open to M&A, to look at M&A in areas that will be aligned to our strategic roadmap, that will help us build the sectors that we want to build, because we certainly want to be a company that is very, very sharply focused on certain domains and technologies. So what aligns with that is what interests us, and we are actively seeking out opportunities there. Should they come, we will certainly, try and take it forward.
Thank you, sir. Is the company considering listing the Infotech business separately?
Well, ITC Infotech is a 100% owned subsidiaries, and listing is certainly a possibility. And these are issues that we examine from time to time. And when it's believed that it would be a good idea to do so, and when it is felt also that it is, commensurate or material enough, and when we feel it is worthwhile doing it in the interest of all stakeholders, I think at that point of time, certainly the board will consider that. But these are certainly, we are very, very open and flexible to these areas. These are areas that we debate and look at the context and look at the timing. So there is a context and timing to everything, and we have to approach it with an open mind and do what is right at the right time, and that's the approach that we will take.
Thank you, sir. I now move on to certain questions relating to structuring and use of cash. First up, what are the demerger plans of the FMCG business to unlock value?
Okay. So, as far as the FMCG business is concerned, the strategy right from the beginning has been to leverage institutional strengths. That's how this business has grown. That's how this business has evolved. And there are channel synergies, there are operational synergies, there are product development synergies. There are many, and of course there are commercial synergies, as in the cost synergies also at play here. So there are many benefits that are available. It is not to say that FMCG businesses cannot be built without this. They can be. But we believe that we should bring something unique to the table, and that's why we brought in the institutional synergies. And you will also note that although the margins are lower, but the fact is the cost of building this business has been reported to be far more efficient than the other routes that would have been available. Right? We built this business at a more efficient basis because we were able to leverage institutional strengths. So this is how we have built it, and this is where we are. From this point, we are certainly open to seeing what is right to create value for shareholders, and these are things that we evaluate from time to time. But when we evaluate it, we certainly look at the maturity of the business context, and fundamentally look at what is required for sustained value creation, because that's a fundamental pillar. Sustained value creation is a fundamental pillar that must be ensured by any enterprise. So we look at those facets also and then take a decision. But these are things that we examine from time to time, and nothing is cast in stone. How we organize ourselves flows from business strategy. If you go back in history, the paper business, the hotel business was a separate business. It was brought in for a purpose. In the year FY20, we took a view as the hotels business was mature. The business strategy also was a focus on the asset right strategy. So we thought it's the right time to look at alternate structure, and it was very clearly articulated in the annual report. We have reiterated that we remain committed and open to it, but it'll have to be done once the industry recovery dynamics are kind of established. It does not make sense to do it when the industry has not fully stabilized it. So this, I'm just giving you these examples to say that nothing is cast in stone. We'll continue to look at it and do what is right for the business to create sustained value, which is what we are committed to, and also to look at all these opportunities for unlock in the context of business maturity and business standard and business context, and do what is right for sustained value creation. We are completely committed to it. And in the past, while this is not the question, but I might also just add that there have been questions or feedbacks on various facets with the objective of value creation. And I did receive feedback earlier on profitability, and that's an area that we at that time also said that we are going to focus it and focus upon that, and also with scale in some of our older businesses, the trajectory is going to change, and that is seen. So of course the discourse is now moved to another question relating to FMCG. Similarly, there was a question on asset productivity as far as hotels are concerned. This question again, in the year 2017 itself, we announced the movement towards an asset right strategy, and work started in right earnest, and we are seeing the momentum build up now. There was also some pointers as far as capital allocation is concerned, and that's what also led us for them to bring in a new dividend, to bring in a very clear and very sharp dividend distribution policies. These are certain steps that we have taken based on certain feedbacks that we have received, and we continue to examine and discuss all the suggestions and questions that we get, and we will do whatever is right for the long-term sustained value creation. We will not do anything that is only merely for the short term. That's the only condition I would like to put as a parameter to whatever we do.
Question relates to structuring of the hotels business, and this has come from several analysts from JP Morgan, Morgan Stanley, Moon Capital, O3 Capital, JST Investments, etc. The company had indicated that it is working on alternate structures for its hotels business. While the pandemic has impacted the hospitality business around the world, what are the avenues that the company is evaluating, and where are we now with regard to these steps?
We are committed to whatever we have stated in FY20, and we've also reiterated this last year, saying that as industry recovers, we will take it forward. I'm mindful of the fact that the whatever route we take has to be formally approved, and then only we can bring it out. So I would not get into the details of that, but I can only reiterate that we are committed to it. It's not something that has been shelved or going to be postponed for the long term. It's certainly on the cards. As the industry recovers, we will do what we have said in our annual report.
Thank you, sir. What are the capex plans of the company in the next 3 to 5 years? Which segments and what kind of allocation can we look forward to?
Supritam, would you like to take this?
So, see, on capex, I think it's good to look at a 3-year perspective and not just a annual number, because capex, by definition is long term, and cash flows tend to be lumpy. Firstly, I think if you look at FY21, it came off a year which was quite disrupted, and we spent only about 1,600 crores. So that needs to be seen as a kind of an exception, as a particularly low number. But I think a good way to think about this is about a run rate of about 3,000 crores per annum. So that takes us to roughly about 10,000 crores. And like I said, it's not going to be linear, but looking at a 3-year perspective, an average run rate of 3,000 odd crores. That could be a good way to look at it. To set this in perspective, like all of you know, our total depreciation for the company is about 1,600 crores. So this is about 80% more than the depreciation number on a per annum basis, which takes us to about 3,000 crores run rate per annum. As far as where this money is going to be deployed. Quite obviously, the large user of this capex is going to be FMCG. Our estimate is that about 35 to 40% of this number would be allocated towards FMCG, largely in creating new capacity. We already have the ICMLs, but as demand grows, we would have to put in more lines, and that's a good, a problem to have in a manner of speaking. As we see demand, we put in more lines in a modular manner. A lot of the infrastructure, the utilities, the base foundations are already there, and we don't have to really spend a lot of money on those anymore. So I think 35 to 40% again would be a good way to think about the allocation to FMCG. The next bigger user of cash would be the paper boards business. By nature, it is capacity-led growth that comes in, and therefore we need to augment our capacity as we kind of reach 100% utilization, which is again a good problem to have. So paper boards is going to be perhaps 25 to 30% around that kind of mark, using cash of that 10,000 crores in the next 3 years. We talked about hotels, pivoting to an asset right strategy. So the hotels that are being built right now, we are almost getting to the final stages. So the cash flows, the residual cash flows would happen in FY22 and a bit of 23 maybe. So if I look at a 3-year perspective, again, hotels should be around 10%, but I think thereafter we should see even lesser allocations to the hotels business because of the large impetus that we are giving to the asset right, the management contract route of growth from here on. We will also have capex in agriculture, in the agri-business, and a lot of work that is happening around digital and sustainability would be the other horizontal users of cash as we go forward. So that's pretty much the way we're thinking about capital expenditure at this point of time.
Thank you, sir. The company has a lot of cash in the balance sheet. How is it thinking about M&As, especially in the FMCG space? In the FMCG business, is there potential entry into new categories? Could you talk about some portfolio gaps that you may plan to bridge inorganically?
So, Supratim, would you like to take this?
Yeah, sure. So M&A, of course, has been called out as one as integral part of our growth strategy. It certainly adds one pillar, one additional vector of growth. And we also talked about exports. I think, other than organic, we are really looking at M&A and exports to be the two newer vectors of growth for the company. Largely, the action is going to be around, I would say, FMCG. And I think the Sunrise acquisition, the Savlon acquisition, the Nimile acquisitions have given us a lot of confidence that we can perhaps strategize well on the key targets and the spaces that we want to look at. So certainly it's an area of great interest of M&A, but it has to be value accretive. That's the main, I would say, filter in a manner of speaking. We want to be not just buying top line and bottom line, but also creating value on the investment that we put out. So I think when we look at assets, and we have a lot of pipeline, we have a lot of deal flow, as you can well imagine. But we have to be choosy about it because we want to create value over the long term. So the key question is, what are the strengths we bring to the table, and what capabilities do we acquire through the M&A route? Some of these filters and some of these thoughts are very, very important for us to select the target. And of course, then it's a question of how do we bring ITC synergies to play. And I think, like in the morning presentation you saw in foods, in Sunrise, we found a very, very good asset where we could bring a lot of ITC synergies to the table. And we also got something really valuable from the asset that we acquired. So really, it's a win-win from an M&A perspective. So I think that's a very good playbook that is there for us. And we are quite, hungry, and we have the appetite, but we need to create value on the asset. So therefore, valuations also are important. It's not that we just want to acquire at any value. Valuations are important, and we would be mindful of that as we go in, because some of the transactions that have happened in the Indian space with 8 times, 9 times kind of sales multiples, those we find very difficult to, fit in our playbook, even if the asset is reasonably good. So that is a filter that we need to always work through. But we are very, very keen to add to growth and profitability and value creation through the M&A route. The spaces we are looking at, like I mentioned, is largely FMCG. It could be regional brands like Sunrise. It could be completely new areas which are adjacencies, like Savlon did in the case of personal care, and Sameer's presentation highlighted what it opened up for us as a company through the latent equity of the brand that we acquired. So I think, like I said, we have a pretty clear, I would say, idea as to what we are looking for and where we are looking for some of these opportunities. And you will see more of this, in times to come.
So if I may just add to it also, is that on similar vein, outside of ITC Limited, our fully owned subsidiary, ITC Infotech, is also viewing M&A in the same manner as Supratim described for FMCG. So that's another area where we are actively pursuing this vector.
Yes, sir. The next question is again got to do with cash in the balance sheet. Will you consider special dividends and or buyback of shares as a way of returning cash to the shareholders?
So Supratim or Rajiv, so Supratim, maybe you can answer you can take this. Yeah.
Chairman can supplement. So I think, firstly, let's look at the overall picture of capital allocation. I think Chairman explained the two large, I would say, changes that have been brought around in the last few years. One is, of course, the asset right strategy in hotels, which used to be a larger user of cash in the recent in the past. And the second one is to actually looking at our needs and our capital expenditure plans and our growth plans. What should be the payout ratio? And we've actually gone ahead and bake that in the distribution policy itself. So we've called out that it's 80 to 85% over the medium term as far as the annual profits are concerned. So we have executed upon that. So now the question is on surplus cash. So if you look at the payout ratios and the kind of cash generation we have, we are not really adding to the cash surplus that we have on our balance sheet anymore. In fact, if you look at March 21 over March 20, the surplus was down by 25% because we paid out more than, based on the new ratio. So actually we've depleted the surplus. Now the question is, as far as special dividends are concerned, that's been a route that we've had followed in the past. But I think there was a lot of feedback from investors, which we, fed back to our board and senior management. And the call was taken that more than special dividends, the value of that return of cash in the form of ordinary dividends is of a higher order. And we listened to the investors, we listened to shareholders, and I must say the board acted quite promptly to take that on board. And we have preferred to pay out, I would say the higher amounts of dividend totally in the form of ordinary dividends. In fact, last year in FY21, although our profits had suffered because of the pandemic, we did not really, step down on the dividend per share. In fact, we took it up as an ordinary dividend per share. Maybe in some other time, I'm guessing this could have, come through as a special dividend. But I think the value of ordinary dividend is better, is higher, because it gives you the predictability, it gives you the certainty and visibility to long-term shareholders. And we really value long-term shareholders, and the feedback was well received by us, and we've acted upon it. Now, the question about, what are the other forms, including buybacks, is always there. Like Chairman mentioned to the response to the previous question, we are open to all these different, methods. But so far, I think, especially in the last 18 to 20 months, our, focus has been to get our earnings growth momentum up, and to also maintain the threshold DPS, the dividend per share. I think we have thought about the DPS maintenance to be a very important, I would say, objective in these times, because a lot of shareholders have come into the stock and they really value the dividend per share that they earn. So we didn't want to kind of let up on that, and we've actually maintained the increasing trajectory of DPS. So I think that's what we have done so far. But as far as the other routes are concerned, they're all, on our table. It's something that, we can constantly look at. And like Chairman said, we are not, nothing is really cast in stone, and we shall look at, all the options possible and choose the best option that, is in the interest of long-term value creation. So I just put it that way, that, so these things are, looked at on an ongoing basis, and the board will take the right decision at the appropriate time.
Thank you, sir. The company has recently acquired a D2C brand, Mother's Purse. What is the specific strategy? Any synergies for existing ITC FMCG businesses?
Okay. We had a lot of discussion around digital during the day, and there was a specific presentation on it where we've also articulated our position very clearly that given the manner in which digital is evolving and digital is being adopted by society, we see ourselves as a future tech enterprise, which is really a future-ready digital enterprise, and that's the shape of things to come in the future. Digital will be a very important component. And D2C is a model that is gaining traction, and the inspiration comes from a lot of the tech entrepreneurs, some of the unicorns, and where successful brands have been created, successful platforms have been created. We also believe that platforms will be a very important tool for brand owners in future. So these are things that we will invest behind, both organically and inorganically. And that is why we have made the investment in Mother's Purse. As far as synergies are concerned, yes, there are going to be synergies of learnings. There are synergies in, we will be looking at synergies as far as innovation is concerned, synergies as far as, creating some offline salience of products is concerned. So all these synergies are on the table, and we will discuss and review those as we go along, and as the business of Mother's Purse evolves. The idea of investing is also to work with the founders and help them scale up and make a great business. So all of these options are available. We have a large R&D center. We have a wide distribution network. We have a lot of talent in the organization. We have skills in digital also. So we will see where two-way, experience sharing can also happen. So all these are possibilities and fits very well with our overall strategy and vision to be a future tech enterprise. And hopefully we will see more of this, not only organic, but more of the inorganic piece going forward in this space as well.
Yeah, we've already ticked past 5 p.m., but with your permission, I'll still accommodate a couple of questions, sir.
Yeah, sure, please.
How is the company engaging with the startup ecosystem is the next question.
Okay. So, first of all, we do invest through certain private equity or VC funds that gives us visibility to a range of tech-enabled brands or startups in the country, and what business models and what progress these companies are making. That provides us information, provides an opportunity to interact. Besides that, we also, participate in various events where we can get updated. We also go to places where such, startups are being incubated or have some centers where they are kind of being mentored. So we have we have a comprehensive network to first get visibility to what is happening, understand what each startup is trying to do. We shortlist some startups, and in certain cases, we have started, though not many, we have started to make direct investments. But there are many more cases where we are directly working with startups in helping them scale up their model, as also, testing out some proof of concepts, and also identifying areas which can be scaled up for mutual benefit. There are a huge number of startups we are working with. So that's the way we address the issue of startups. We have a dedicated cell that is constantly in touch and integrates, identifies the startups and links them with the respective business. So there is kind of undiluted focus on this space. We also have a fund set aside for us to invest, whether through private equity or directly in the startups for this purpose. So it's an area that is receiving a fair bit of, or a lot of attention, I would say, within the company.
Thank you, sir. The last question, this relates to shareholding. Foreign institutional holding in ITC has been coming down due to ESG concerns. On the other hand, you have been highlighting that ITC's ESG credentials are top grade. Can you please briefly talk about any specific engagement that ITC is having with foreign institutional investors on ESG and what their concerns really are?
Well, this is an ongoing engagement with investors where we share our ESG credentials. We also share our roadmap and our vision. As my colleague Nazib articulated during the day, this is an ongoing activity. And it has been very clearly acknowledged that ITC's credentials in this space are exemplary. There are, of course, various views that investors have taken on ESG. Some have chosen to take a route of exclusion. Some have chosen, or some are in fact moving towards what is now understood as a holistic integration, and which is more about how you are transforming, how you are conducting your business. So this is an area that is evolving from only exclusion. We are finding a move towards the other part. But this is an evolving space, and we have to watch it. And there are clearly funds that have taken a view that we do not wish to invest in a set of sectors, and there are funds that are now moving towards the idea of holistic integration. So there is a churn happening, but we continue to remain engaged, continue to share our credentials, and continue to invest to strengthen our credentials, whether it is from creating environmental capital, social capital, or also from providing exemplary governance standards. And you had visibility to all of this during the day.
Thank you so much, sir. We've already been here for about 6 hours. I'm sure there are plenty of other questions that we've not been able to accommodate in the Q&A session, but we must draw a line somewhere. I wholeheartedly thank the panel for comprehensively answering the questions that have been asked by analysts. I also hasten to add, I thank all the analysts for putting in the questions today through the chat box right through the day. Thank you so much. May I now request you for your closing remarks, if any, sir?
All right. Thank you. Thank you, Karthik. And first of all, may I thank all of you for joining us today and being here for this rather long session. And I'm quite encouraged by the range of questions that are asked. And I thank you for the interest that you have in the affairs of the company. And as I close, I'll just reiterate that we are completely committed to creating long-term value for shareholders and for all our stakeholders. This is what our primary role is, and the fundamental of that starts with competitively superior performance, which we have delivered and which we continue to focus on in the last few years up to the pandemic. Our EPS went up by 47%. We've also seen the trajectory in FMCG during that period, and we are also now seeing the recovery. So performance is receiving the right kind of attention. We have also shared with you what ITC Next encompasses. ITC Next is the focus is to make the organization contemporary, make sure the organization is nimble and consumer centric, bring in the contemporary skills and technologies that are required for organizations to win in the future. It's about identifying newer vectors of growth in each of our businesses. It's about addressing or tweaking our strategies or bringing in new elements in our strategy to address some challenges or headwinds that our businesses have faced in the future. And all this is certainly work in progress. And all this, a lot of it has already been, it's not that it's just suddenly happened. These are things that we have been working on in the last 2-3 years. And we are starting to see the results of that. And the results that we have achieved so far certainly give us immense confidence. So we look to the future with immense confidence. And we believe that the kind of performance that we aspire for, we should be able to deliver on the back of our institutional capabilities and the robustness of our strategies. And with this, I once again thank you very much for being here today, and thank you very much for your support. And if there's anything else you wish to know, I think the investor relations team is always available. Thank you very much.